Hello everyone, welcome to episode 2 of this series. We're going to be discussing the model in this video, which is a change in the state delivery. I'm going to be discussing bullish and bearish changes in the state delivery, where to target, where to have your stop loss at, and I'll go over a numerous amount of targets. So a change in the state delivery is an order block. Most of the time, when I'm finding draw and liquidity targets, I'm using order blocks to find draw and liquidity targets. And simply what I'm looking for is in a bullish change in the state delivery, I'm looking for a down close candle or consecutive down close candles. Then I'm looking for price to close above that order block, creating a fair value gap. When that happens, what I look for is for price to start targeting liquidity above. So let's say that this is just one down close candle right in here. Well, then I just look for the first down close candle and mark out the open of that. It's the same logic that we just talked about in the previous episode is for this. So just think of order blocks, and you're just looking for an order block to be validated by price closing above it. Once price closes above it, I look for the highest point of this last down close candle. So if there's two consecutive down close candles, and then let's say there's even like an upper wick here, I want to see price close above that upper wick. For some reason, it's not letting me put it in the middle there, but if I'm looking at a bullish change in the state delivery, right, I want to see price close. Now, I've seen ICT just refer to the open of this, and he just wants to see price close above that. For this model, I just strictly wait for price to close above the upper wick of the order block. I also look for price to create a fair value gap after it does that, or kind of as it's doing that. So label this BISSY. Once we get this, right, the last up close candle before price creates those two down close candles, that's where the market structure shift occurs at. If you ever see me refer to a market structure shift, that's not really what is going on here. What is going on is we're getting consecutive down close candles. When price closes above that, creating a fair value gap, this puts in a change in the state delivery. And really what that means is that the market has moved from a sell program. If it's moving from up here, it's moved from a sell program into a buy program. This is kind of the inception of that reversal. So when I'm looking for a long setup, I'm looking for an order block to form. I'm looking for price to close above that order block. And I'm looking for a fair value gap to get created. Now, when that happens, right, then I can start to target liquidity above. And the main target is going to be buy side liquidity. So if I see this and then there's a level of buy side up in here, okay, well, I'm going to target that buy side. And it really just depends on good RR. There's a few different ways to get in here. You could either enter as soon as it does this. So as soon as it creates the fair value gap and closes over that order block, you could literally enter right there. If the buy side liquidity is high enough and you're anticipating for it to trade up to there, you could enter at I typically enter at a 1 to 1.5 RR at an absolute minimum. A lot of the times my RR is much higher than that. But the minimum RR that I am allowed to enter in within my strategy is a 1 to 1.5. So if I were to enter as soon as it closes up here, I can't enter at a 1 to 1 RR. So if I put my stop down here, and let's say the target's up here, well, I can't enter into that. I would need price to retrace back down into the order block at that point and then enter at a 1 to 1.5 RR trade. It really just depends on what your risk management strategy is. We will talk about risk management later on, but it's personal preference here. So it doesn't really matter where you enter. Some people are thinking, well, where do you enter in this? You could enter once it taps back into the order block right here, this blue line, whether that be the open or the upper wick. You could enter as soon as it taps into the fair value gap. Ideally, you don't want to have your entry all the way at the fair value gap low, though it can retrace back down to there and you can get a high RR trade. You don't really want to see it. When I'm looking at a bullish change in the state delivery, I don't want to see it always completely refill in the fair value gap. And the reason that is because it shows weakness to me. If price is all the way up here and it validates a bullish order block, and as soon as it does that, it's quickly to reprice back to the fair value gap low and tapping into this last down close candle, that's a sign to me that we're not in a heavy buy program. And either we're in a high resistance liquidity run where it's not going to move fast to that buy side target, or I'm offside and it's going to head for the stop loss. So again, a few places to enter. once it taps into the fair value gap. You could do mean threshold of the fair value gap, which is just the halfway point. Again, I don't like to require a lot on the retracements. Like, I don't like to require it to pull down to 50% because it's not guaranteed to get in. Typically, I will enter if it taps into the fair value gap or if it taps into the order block, right? Or if the RR is high enough, as soon as it closes over the order block, I will enter up here. Again, at a minimum, 1 to 1.5 RR. Main targets, buy side liquidity. So you're targeting old highs after that happens. Other targets could be a breaker or a fair value gap in a premium. So for example, I'll draw this out real quick. Let's say we have a breaker up here. Okay, so at this high, we have a high, low, higher high. That's where the buy side liquidity is. And then it makes a lower low right here. So in this leg that makes the low, remember there's going to be a breaker there. So if price trades back lower here, let's say it taps into the fair value gap. Remember, the safest stop is going to be beneath here, but sometimes you could have it. So let's say that there's a fair value gap in here and candle number 1 of the fair value gap, let's say it's like right in here, you could have it beneath there. The safest stop is going to be at the low, but you could target the breaker for a low hanging fruit target. So if you're not anticipating or you're not sure if price will run all the way up to the buy side liquidity up in here, okay, what you could do is just target that breaker. So as soon as it taps 1 tick into the breaker, that could be a target. What could also be a target, let's say that this is even a little bit higher up. Let's say the buy side is all the way up here. So sometimes it's not always going to be that close. What you could do, like I stated right here, you could target a fair value gap in a premium. So from this high where it started that delivery and that speed to the downside, you're going to draw a fib on that from that swing high to the swing low of where the order block came in. You're going to draw, all you want to focus on is 50%. So I'm actually going to do premium discount. So I just have a preset. All you need to do is click on 0, 1, and 0.5. And once you have that, you can click Save Drawing Template and just label it premium and discount and click Save. So if I'm not positive that price is going to head up to the breaker or the buy side liquidity, again, 90% of the time, I'm targeting the buy side up here. Because if I'm on side with smart money and the draw on liquidity is higher, right, I'm aligned with order flow, then it should target the buy side. So just note that 90% of the time I'm targeting the buy side. If I'm not positive, I'll target the breaker. Or if I just want, again, a low hanging fruit target, or maybe the RR is already good just to target a fair value gap and a premium, I'll do that. So I'll draw a fib from the swing high of a drastic move to the downside to the low of the breaker, and I'll look for a fair value gap above the 0.5 fib. So whatever that first one is, I don't want to see it overlap the 0.5 level. I want to see it completely above the 0.5. So maybe that first fair value gap is up here, and it's going to be a bearish fair value gap in this price leg. I could target that. So again, the few different targets: buy side liquidity, low hanging fruit targets, breakers, and fair value gaps and premiums. 90% of the time I'm targeting the old high up here. If I'm just looking for a low hanging fruit target, I'll target a fair value gap above the 0.5 fib or the breaker. Okay, so we have the high, low, higher high, lower low, the down close candle or series of down close candles in the low. So that's the bullish change in the steady delivery. We'll be diving into some real chart examples in a second. I'm also going to be diving into one of the big mistakes that a lot of ICT traders make with market structure shifts. So anytime I'm referring to a market structure shift, if you see me post in the Discord, we have a market structure shift with a fair value gap. Really, what already occurred is the bullish change in the steady delivery. So when price breaks over, so this up close candle in here, right? Once price makes the 2 down close candles, this might even be a little bit higher sometimes. When price makes those 2 down close candles in here, okay, and then it pushes up higher, anytime I say we have a market structure shift, I'm already including the fact that it has created these 2 down close candles, which is the order block, and then broken higher, creating the bullish fair value gap. That makes it a real market structure shift to me. So this is my focus, the close over these 2 down close candles. Now, what if there was 3 down close candles here? Then I'd mark out the highest point of the 3. What if there's 1? I'd mark out the highest point of the 1. So we're going to dive into the bearish example now. again, it's just an order block. You already learned that in the previous lesson. We're looking for an up-close candle or series of up-close candles. We're looking for price to close lower, creating a bearish fair value gap in this example. We do have that right here. Again, the lowest point of the up-close candle. So I'm not, now ICT might do it differently. This should say SIBI, bearish fair value gap. ICT might just use the open. Personally, from what I've learned and just my experience of it, I've found it best to just wait for price to close below the lower wick of those two up close candles. Once price can do that and create a bearish fair value gap, right, I'm targeting sell side liquidity 90% of the time. Other targets can be breakers in a discount or a fair value gap in a discount. Or sorry, did I say breakers in a discount? I'm either targeting a breaker or a fair value gap in a discount for the low-hanging fruit target. So how am I going to enter here, Dan? Well, as soon as it closes beneath these two up-close candles, I could either enter right there and target the old low, which is the sell-side liquidity, or I could wait for it to pull into the fair value gap as soon as it taps into that, or as soon as it taps into any part of these two up-close candles. I'm not looking to enter once it fully reprices this fair value gap in with my stop loss above there, because a lot of times that doesn't happen. And if it does do that, if it does just completely reprice that in, most of the time it'll just head for the stop, or you're just looking to get some chop around here. You're looking for some time distortion before true delivery in that directional bias. So again, I'm not requiring a whole lot for my entries. I don't want to make it hard for the market to perfectly hit my entry before already going to a level below the market price. So I'm not requiring a lot from the market. As soon as it forms this, either I'm entering right there, or again, tapping into the fair value gap or tapping into the order block. And again, if I'm not targeting the sell side liquidity, which is the low right here, what I could also look for is I could look for a breaker. So we do have, at the inception of this move down here, we have a low, high, lower low, higher high. So in this price leg where price created this high right here, we're looking for an up close candle or series of up close candles. I could target that breaker as a low hanging fruit target. What I could also do is draw a fib from the swing low of where that breaker is, the inception of the delivery to the upside, and I could look for that 50% level. Now you may say, well, Dan, that's super close to the 50%. A lot of times it's not going to be. So it's not like, I mean, a good amount of times it might be, but that's why I'm targeting the sell side liquidity. But in this example, this is just insanely close. It wouldn't be that close, or I wouldn't be targeting it if it was that close. But in this discount below the 0.5 fib, you can look for the first bullish fair value gap. So in a bearish change in the state delivery for a low hanging fruit target, a bullish fair value gap in a discount of the range, or a breaker, those are low hanging fruit targets. Main target will be sell side liquidity. In a bullish example over here, it would be a bearish fair value gap and a premium, like we talked about. So this is the bullish and bearish change in the state of delivery. Again, the safest stop will be beneath the low of the order block in the bullish example, and the safest stop in the bearish example would be above the order block. So now let's look into what I look at as a false market structure shift versus a real market structure shift. So in this example, you could see that price is moving higher. It trades lower, moves back higher, and then makes what a lot of people look at as a lower low right in here. I'm not looking at that as a market structure shift. And the reason is because it didn't disrupt any order flow. And you'll see what I mean by that in a second. So when price does this, right, I'm just considering this a pullback until it proves to me that it has created a real market structure shift or a bearish change in the state delivery lower. In a bullish example, when price creates a low, high, higher low, then a higher high, I'm not looking at that as a market structure shift. I would need this low to take out that previous low right there, and I would need this high to take out this previous high right there. I'm going to be going over why that is. So if we move on to the next example, again, if I see an order block form in this price leg right here, a bearish order block, and if I see bullish order block form in this price leg right here, a lot of times I am not taking that. And the reason I'm not taking that is because a lot of time it'll present false setups. This is more of a true market structure shift. This is a bearish change in the state delivery. This is a bullish change in the state delivery. So in this example right in here, when price moves from this low to this high, there's going to be an up close candle or series of up close candles. This right in here will be a down close candle. This right in here, a lot of the times, is a bullish order block. When price moves lower and breaks lower here, it's disrupting bullish order flow. So once it closes beneath the bearish order block, a lot of times this down close candle is breaking through a bullish order block. So ICT teaches across various mentorships on his YouTube that when institutional order flow is bullish, down close candles are acting as support. When institutional order flow is bearish, up close candles are acting as resistance. If that's true, when price breaks beneath this down close candle in here, it's disrupting bullish order flow. So this down close candle is no longer acting as support and price is breaking through it. So we're killing two birds with one stone here. It's creating a bearish change in the stayed delivery while breaking through a bullish order block. So it's disrupting bullish order flow while creating a change from buy to sell program. Here, we don't have that. And why don't we have that? Well, because if this is the low down here, okay, that price has kind of bounced off of, and this is the high up here where price has rejected and traded lower, price would need to break above that high to break through this bearish order block right here. So I'll dive into a real chart example in a second, and price would need to break through this low to break through the bullish order block. Because think about it. This is a bullish order block. Price traded away from it. No bullish order flow is disrupted if price just broke beneath this previous low. Similarly, over here, no bearish order flow has been disrupted if price just broke above this high. All it did was set a short-term high and broke above it. So I want to see price break above here for a true market structure shift, and I want to see price break beneath here for a true market structure shift. I am not looking at this as a real market structure shift in here. The highest probability changes in the stayed delivery occur when it's aligned with order flow, when liquidity is purged, and there is a change in the stayed delivery. This forms every single day. Doesn't mean you're going to be right every day. Doesn't mean you're going to catch the move every single day. But knowing it's there every single day should provide some sense of security and not feel like you have to catch it every day because you know it's going to be there tomorrow. And since you know it's going to be there tomorrow, it should reduce FOMO. So this has been a game changer, knowing that it forms every single day. I don't really care if I trade for the day because I know it's going to be there tomorrow. And knowing that, it takes a lot of stress off your shoulders. So now let's dive into a real chart example on the NASDAQ. This works on every single time frame, by the way. I look at it from the 1 minute time frame and above, all the way up to the monthly plus. It's not necessary to go beneath the 1 minute time frame. There's already enough noise on the 1 minute time frame where you can get chopped up. If you go beneath the 1 minute time frame, you're going to see so much of this model. And it's so easy. Like once you see this model, you're just going to go on the chart and you're going to think that every time it should work. But that's not the case. And in this series, my goal is to kind of show you guys the refinements of when it doesn't work, when to trade it, when to not trade it, as that's the most important part. You can go in here and you could find the model and you'll see it fails because it doesn't follow certain criteria. I'm here to try and provide that criteria for you guys. So I'm looking for liquidity at the inception of these changes in the stayed delivery from the left side of the chart. So see this level right in here? That's sell side liquidity, or an old low right in here. This is only 5 minute chart. Again, I can scale between the 1 minute to monthly. Any time frame in here, you will find it on that time frame. On the 1 minute, it does present lots of opportunity. When price breaks beneath this previous low in here, what I'm looking to see on a lower time frame is, do we get a change in the stayed delivery? Now on the 1 minute time frame, there's likely a lower time frame model in here. We could actually check that out real quick. If we go down into a 1 minute, as soon as it takes out that sell side liquidity, right? See these 3 down close candles in a row? Since there is 3 in a row, I'm using all 3. Notice how we get this little pop up here. There's no model. Notice how we get the little pop up here. There's no model. Little pop up here. No model. I want to see price close above this order block, okay? And lower time frame changes in the stayed delivery can lead to higher time frame changes in the stayed delivery. I want to see price close above these 3 consecutive down close candles. See the up close candle right here? That's like the true market structure shift level. I don't care about that. When I see this signature, when price closes over the order block with a fair value gap, again, it needs a fair value gap. Dan, what happens if the fair value gap forms up here? It's not valid then. It needs to form in some part of the fair value gap must be in close proximity, extreme close proximity, either touching or just right above the order block. This is right in the middle of that order block. So this isn't valid yet. I need to see it close above this down close candle. Okay, price closes above it right here. If you go back to December 22nd, 2023, in the Discord, in the intraday ICT channel, you don't have to do this, but this is where I turned bullish and I said I want to see price start targeting buy stops above. Why did I say that? Because we had a change in the state delivery after price ran sell side liquidity. What did we just talk about in the model? When it does this, it is moving the market and the algorithm from sell to buy program. It's disrupting bearish order flow. It's breaking above this up close candle. If order flow is bearish, you want to see that up close candle act as resistance. It breaks above that there. So this is important that it breaks above there. I don't need to see it break above there. I just need to see it break above that down close candle. So once I see that, this is a bullish change in state delivery, and I'm looking to target buy stops. So I could buy it right there, and I could start targeting these highs. Okay. Now, these are very low-hanging fruit highs because there's not going to be a lot of stops above here. It's likely to head for the stops all the way up here. And the reason that is because there's going to be more liquidity up here. These are just very minor highs, but it's still good to target highs like this. Where would the breaker be to target? Well, if you see right here, this is a bearish breaker. So this could be a target here. You could also view this as the breaker. This down close candle, actually we're going to go to like a 10-minute time frame. If you look at this down close candle, you could also say that that's a breaker. And the reason you could say that's a breaker as well is because price made a high right here, a low, a higher high than a lower low. So we'll just say that this is the low hanging fruit breaker right here. There's buy side above here as well. And this is where you could have got in. So you could have bought right here. Again, all I need to see is it close above there. Now, some people look at this as chasing. But if price is going to head all the way up to here, why is that chasing? It's not chasing. Actually, in perspective, if you bought from all the way down here and price heads all the way to up here, it's actually a very good entry. I'm not requiring for it to pull back into this fair value gap. Now, if you look at the next candle, right, maybe it traded back down a little lower. It could trade into the order block. You could have your entry there. You could wait for the fair value gap again. I'm not requiring that, okay? So I want to target the buy stops above. Now, where would I target here? Well, my stop loss can either be beneath candle number 1 of the fair value gap, or in this case, since this is candle number 1, this is 2, and this is 3, this candle number 2 is so close to that low, so I just have my stop there, or the safest stop would be at that previous low right there. In this example, I just have it beneath this low since it's so close to that previous one. And my RR needs to be 1 to 1.5 RR. Does that mean that I'm just going to target a much higher level than what I'm supposed to in this model? No. It needs to be 1 to 1.5 with me already targeting the levels that we defined over here, which is the buy side liquidity, the breaker, or the FVG in a premium. So in this example, right, it's likely to head for this high up here because these are just very small highs. If I just wanted to get out at a 1 to 1.5 RR, it would be towards the high end of that breaker. So if we let this play out from here, see that price heads higher, and then it hits that at a 1 to 1.5. The breaker, this is a low-hanging fruit target. Since the market was closing, this is an area where you could get out at because it does just kind of consolidate, I believe, the rest of the day because I was in this. I did a entry down in there. You can see that price just consolidates throughout the rest of the day, but it's likely to head up to the buy side. If it's later in the day, it doesn't always deliver within that time period. As you can see in this example, it does not. So this is 4 p.m. right here. This is where we close right around in this breaker area, but a 1 to 1.5, the low-hanging fruit target is the breaker. If we just let this play out in here, from that 1-minute change in the state delivery, I'll skip this ahead on the 30-minute time frame. We would be holding for that buy side to get hit, and it just gets hit right there. So my advice to you is just, if you're going to trade this model, do the absolute lowest leverage to practice with it. Or if you're new, just practice with a demo for months, okay? Because it's important to understand the model intimately before just jumping into trading live funds with it. But this was nice delivery. This is what we look for. So you saw me use the breaker as a low hanging fruit target for a 1 to 1.5 RR. It's likely to head for the buy side above. What is another target, Dan? Well, what I could do is I could draw a fib from the inception of this move down. So this high really started that delivery lower. Draw it to the low of the order block. And I could target the first fair value gap in a premium, so above the 0.5 fib. See how this fair value gap is overlapping that 0.5? Well, I'm not going to be using that. What's the first one then? Well, the first one would be right here, and it delivers to that perfectly. Okay, it delivers to it, and that's where it kind of gets chopped up for a second, and then it delivers higher overnight. Yeah, this was overnight on Monday. That is a bullish change in the state delivery. Let's dive into a couple more examples in here. Again, it's just like order blocks. So the way you figure out if you're going to use a down close candle or a series of down close candles is which one does it present. So on the 1 minute down in here, if we look back at this, see how there's 3 down close candles? I'm using all 3, and I'm looking for it to close above the high of that order block. So changes in the stayed delivery is when price moves from sell to buy program or buy to sell program, and it starts attacking liquidity. If price is already set to go lower, a bullish change in the stayed delivery may just reprice price back into a premium and then trade lower, or back to the breaker, then trade lower. If you're aligned with order flow, it should attack liquidity higher. Let's dive into another example. I'm going to stay on the 5 minute chart here. Let's get out of replay mode. And if we look back over here on the 5 minute time frame, we do have a change in the stayed delivery here. So we have this old low. Again, I'm looking for liquidity to get purged. So we have this old level of sell side liquidity. Price takes that out, and then it starts to trade higher. See how we have this down close candle right here, and then we have this little doji. I don't consider this as the high of the order block. I consider the doji a part of the order block, and that's just a personal refinement. So I would need for price to close above this down close candle. I look at that as the start of the consecutive down close candles. So we have 1, 2, 3 down close candles in a row. I don't count that because this one went lower. So we have 3 down close candles. This is the order block. If price closes above that, which it does right here, and creates a fair value gap in the price leg from low to high, again, it either needs to create the fair value gap in this price leg, or it needs to be kind of like overlapping up in here. And the reason that is because if it's just constantly chopping around, right, moving back and forth, you're going to see this. And it's not smart money's footprints for higher prices for price to just be chopping around to take out the buy side. A lot of time, if it does that, you'll see that it's just a retracement to take out liquidity before heading lower. Again, sometimes it may just run higher without the fair value gap. You miss the move in that case, and you'll learn to be okay with missing the move when you know the setup's here every day. So it takes out sell side liquidity, creates the bullish change in state delivery. Where are we going to target? Where is going to be the target? The buy side liquidity. Again, this is the target most of the time. You could aim for fair value gaps and premium or breakers. Those are low hanging fruit targets, so we're not really going to be expanding on that more. Just know if you're not super confident for running the buy side, that's another level to target. Okay, we're mainly targeting the buy stops above. So this is the buy side liquidity when price retraces back down. So this is at 9:30, right? If you're trading 8:30 to 9:30 or anywhere in that time period, you're likely getting in around this price area. You could have your stop beneath the low down here. That's the safest stop placement. That would be candle, actually not candle number 1. On higher time frame it might be, but this is just the low of the order block. So that's going to be the safest stop point if you got in the fair value gap. Targeted the buy side liquidity, not high enough RR. I believe your stop is safe if you have it right beneath here. Why? Because there's no fair value gaps beyond this point. So see how there's multiple fair value gaps in this price leg? Okay. The low near that lower wick, this is often a safe place for a stop. Because price is not likely to trade into this lower wick. If it does trade in that lower wick, likely it's going to head for the stops beneath here. So I'd rather just keep it right there than have it all the way at that low. After that, after you enter, right, we're targeting the buy side liquidity above. This was a bullish change in the steady delivery. You could see it, price respected that bullish fair value gap and then traded to the high. So that's going to be it for the bullish changes in the steady delivery. Let's move on to some bearish examples. So over here, you can see that we do have this level of buy side liquidity. Okay, price runs out these equal highs, trades lower. So this is an example where the fair value gap forms just in that price leg, just barely in that price leg. We do have a fair value gap right in here. This is a little small SIBI fair value gap. We have the 2 up close candles. I'm looking for price to close beneath there. This, as soon as it closes beneath it, that's a bearish change in the steady delivery. And where is price likely to target next? It's likely to target liquidity lower. So we have the old low right there. And then we also do have the old low over here. Okay, so looking for a close beneath these 2 up close candles. Price closes beneath it. Notice how we have a fair value gap just touching that order block. That's fine for me. Once price trades back higher, you could enter and then target the lower liquidity right here and then also right there. It disrupts the bullish order flow by breaking through this bullish order block over here, and also creates a bearish change in the steady delivery. Here's another example over here where we do have this high. Price comes back up, trades above it, creates this up close candle. Notice how we just have 1 up close candle in here, then price breaks lower, creating a bearish fair value gap. That is enough, right? Because we have an up close candle, price closed beneath it, and then we created a bearish fair value gap. So this is our bearish change in the steady delivery. It's likely to attack the sell stops below, so the old lows over here. So you could enter once price returns into the fair value gap, stop above the high of the order block or right above this candle number 2 of the fair value gap because it's not likely to trade up there, and then target the low. This is a little over a 2R trade. I like to put my take profit, didn't mean to have that say SMT. I'm supposed to say sell stops. I like to have it just at the low, the take profit, because if I have it 1 tick below, sometimes it literally just moves 1 tick below and then reverses. And to make sure that you get filled on an order, it's just important to allow the market to go 1 tick past your limit order. So if I have it at the low, I'm anticipating for price to trade at least 1 tick beneath this level of sell side liquidity. That ensures that I do get filled. Okay. This is a bearish change in the steady delivery. Let's look at one more example before we wrap up this video, which is going to be right over here. Sometimes it just runs without you, right? Price creates this old high, moves away from it, trades back above it, right? Consolidates in here, breaks higher, creates this last up close candle. Okay, I'm looking for price to close beneath there. Why just 1 candle? Because it only created 1 up close candle. Down close candle was right before that, so all I need to see is it closed beneath this up close candle in here. It does right in here, and we do have the fair value gap up here. Okay, so when price creates this change in the steady delivery, it is likely to attack the lower liquidity or the sell stops. So it's going to attack that old low. Okay, so where would I enter in this case? Well, as soon as it closes beneath the fair value gap, you could enter, stop loss above this high. Okay, this isn't a high enough RR trade for me to take. So in this example, I just would have missed the opportunity if I was trading the bearish change in the state of delivery. So that's going to be it for episode 2 on the change in the state delivery model. Make sure you stay tuned for tomorrow's episode, which is episode 3. I'll see you guys later.